in our
Mr.
broad
Borden?
strategic plan for
You can do
kids,
that.
which
Go
you
ahead.
see.
Thank you, Madam Chairman, and thank you, committee. I am Tom Maynard. I'm a member of the State Board of Education. I chair the PSF Corporation Board of Directors. And when the corporation was formed in 2021, our intent was to transform the organization and to take a fund that had been historically underperforming and to unleash it and to do great things with it. I feel like that we are doing that, and it's been my honor to serve, to have this gentleman on board as our CEO, CIO, and he began with us on December 1st of 2023. We hired him because he not only has managed significant public funds, but has worked in the private sector and has done a lot in terms of just bringing a new culture, a new private sector culture to the fund. And Mr. Bob Borden.
Thank you. Mr. Borden, you're recognized.
Thank you, Madam Chairman, members of the committee. I appreciate the opportunity to be in front of you all this afternoon. And thank you, Mr. Maynard, for that introduction. I suppose I should say that I am a product of Texas public schools, so I'm eating my own cooking for sure. In fact, started my institutional career in 1982 in the Texas State Treasury under Warren G. Harding. So I've got some long roots here and watched the history of the PSF and the PUF over the last few decades, and was thrilled to see that this body supported and passed Senate Bill 1232 to create a special purpose corporation. I think that will allow this enterprise to generate significantly higher risk-adjusted returns into the future. And I liken this to, when I talk to a lot of folks, as a 180-year-old, $60 billion startup operation. Because when it was coming out of the TEA, there's a lot of things that we had to build from scratch, like our own IT support systems, our own internal audit, and building out the rest of the accounting and the like. So there's very, very much a startup aspect of it. But I think we're at a unique point in time that if we change the culture and the processes at the Permanent School Fund, we can make a difference for the next 200 years that generates sustainable additional funding for the available school fund. The first thing we did after I started at the very beginning of last year was develop a comprehensive strategic plan that goes down all the way to the individual job task level for each employee. They all have their role in the plan and know where they fit in and know where everyone else fits in. And we reconstituted all the job descriptions. That plan was a 7-point plan, but it's really three things. It's the investment portfolio, it's the talent, and it's governance and internal controls. And an endowment is really just a human talent function. I'd say 85–90% of the costs are in talent, with the rest being in technology and some supports. So the strategic plan goal number one was to revise the asset allocation to be more in line with our peers of large endowments. And historically, this fund has been, to a fault, invested in a rather conservative mix. The principal reason was the secondary charge that we have from the legislature in running the bond guarantee program and providing a backstop to guarantee bond issuances by school districts that otherwise couldn't avail themselves of a AAA rating. We're able to put support behind those bonds, allow them to float bonds at a AAA rating, and we estimate on a run rate that saves the school districts about $400 to $500 million annually. So it's a very important function, but it was not quantified what was really required out of our balance sheet to do that. So we put in place models to determine the implied creditworthiness of our book of assets under different mixes. And what we found was we actually had a lot of room to be invested more like our peers. And so that opportunity cost of being, rather risk averse was significant. And what we're trying to do is unlock that value so we can make higher and more consistent contributions in the available school fund. Indeed, that change to asset allocation, along with the fact that we moved $28 billion of the $56 billion last year, allowed us to rationalize and underwrite an increase contribution to the ASF for the next biennium of $500 million to a record high $4.8 billion. Some of this is mentioned in my deck on page 3 and 7. I'll call your attention to that. So in moving those monies, that $28 billion, we have a philosophy that we're following, that we euphemistically call Texas First. We've got a very rigorous underwriting program. We met with over 2,000 investment management firms last year. We hired 48. So there's a big process of how we cut through, separate the wheat from the chaff to get down to the best of the best firms. But when we get in the final throes and we're really at the cream of the crop, we have a mindset that, all else being equal, tie goes to the Texan. And so we were able to place $19 billion last year with Texas-based firms, Texas headquartered firms, and investing in Texas corporations. The second part of the investment goal is the essence of what our ask is. We think that not only with the better asset allocation, but a better implementation within that allocation in specific asset classes, we might be able to generate on a run rate somewhere an additional $500 million, $1 billion, $5 billion annually through more thoughtful implementation, particularly in our private markets portfolios. And that is the lion's share of the ask that we have. It's 24 people over the next biennium, roughly split 2/3 in the investments and 1/3 in internal control, legal, and other operational support. That's what we believe is required in the human talent space to execute on our goal to, and what we intend, the outcome of that is that we're making significant increases to the contribution to the available school fund, which I might point out for the public. Obviously this goes directly to the benefit of all K through 12 schools in the state. But even if for those who don't look kindly on public education, every dollar that goes into this fund is a dollar of property taxes that doesn't otherwise have to be levied. So it's a profit center for the state as a whole as well. And I think worth making sure that we're running this as efficiently as we can. So the effect of these asset allocation changes are already shown. If you look at page 6 on our deck, we're finally showing some strong improvement versus our peers. We historically have kind of been basement dwellers when we compare it to other large endowments like the Harvards and Yales and Stanford and UTIMCO et al. But now we're seeing the effects of moving the assets more in line with our peers, and we are significantly improving our relative ranking. So the investment program is backed by the talent goal. The incentive compensation program has a lot of attention and eyeballs on it, but I want to describe for a second the process. We have a committee that's a standing committee on compensation and budget. It's chaired by one of the governor's appointee to our board, Mr. Brad Wright, who's a asset manager and attorney out of Houston. We engaged Mercer, who's kind of the acknowledged industry leader in compensation plan design, and we had 27 meetings, committee meetings and board discussions underwriting this plan last year. By the way, they're the same entity that also underwrites the plans for UTIMCO and TRS and others. So that was the nexus of our ask on the comp side was underwritten in that fashion. It's not arbitrary at all. Matter of fact, the entire budget is a bottom-up budget that's built off of the strategic plan. Every one of these goals has a breakdowns of objectives and strategies and job tasks behind it. They're assigned to individuals, and all the costs in our plan are rolled up from that granular job task level. So there's nothing in our plan that we haven't accounted for, and there's nothing in this budget that's not related to our plan. It's run very, very tight. The third leg of the stool, if you will, was strengthening the internal controls and governance of this enterprise. One of the first things I found out is we had some severe issues in some of our internally managed portfolios, some compliance issues, some culture issues that required some wholesale sweeping changes and elimination of programs and people around them to show, I guess, demonstrate that we are frugal with the monies. When the board hired me, we had roughly 100 FTEs, and I was told we had approval to go, to almost 125. We cut 20% of the staff last year. We eliminated certain positions through efficiencies, but there's other positions that are critical positions, but we had the wrong people in them, and they're no longer with us. And it's my experience that if you're going to change the culture of an organization and grow it and add talent to it, you cannot do that with a core that is not solid. And so the cancer and the deadwood have been moved out of this organization. And, it's not a pleasant task, but it's a task that, has to happen up front to truly change the culture. We led with, as a result of some of those things, that developing an internal audit division was priority A1A, and recruiting a chief audit officer and staffing the internal audit program. We also hired KPMG with the support and permission of the state auditor's office to be our primary auditor, and they bring a lot of expertise in being able to audit and understand the highly complex investment program that we have. So KPMG's on board. They completed our audit for last fiscal year. We likewise have a standing audit and ethics committee that's chaired by Dr. Kevin Ellis, that I'm sure you're all familiar with from time to time. So where are we going with proxies? With the governance, one of the other things we did was take the guidance from Senate Bill 13 very seriously. We moved to cut ties with firms that, were touting ESG programs that were blatantly anti-oil and gas, and we've severed all relationships with billions and billions of dollars that we've moved away to other firms. We implemented the first ever ESG skeptic proxy voting plan, that the thousands and thousands of proxy votes that we have to file on all our publicly traded companies now are, affirmatively voting against management if they have anti-oil and gas policies, or if they are using, ESG or DEI concerns in their daily, running of the business. We're trying to go back to the fundamentals that, the management of the companies should be purely driven on increasing shareholder value, increasing our returns so we can return money to the state. And at the end of the day, I'll call your attention to page 13. Even with this fully loaded plan and budget, we are a low-cost provider. We are cost of less than 0.1%, all loaded, of our asset base to administer this plan. You'll see that is about 30% below our peers, even in this state, and half of what our legislative ceiling is. So I call that to your attention, in as much as we still are running a very lean organization and spending money where we need to and making sure we're getting a bang for the buck. So that concludes my kind of monologue here on what we've got in front of you, and I'm happy to entertain any and all questions y'all may have.
Thank you, sir. Senator Schwartner has a question for you.
Thank you, Madam Chair. Regarding page 6 there, the graph outlines PSF's performance relative to a peer group. And from what I read there, the peer group is the BNY endowments and foundations greater than $1 billion universe, which has 50 members. Is that correct?
Yes, sir.
Is that common for, well, is ERS and TRS in that group?
No, because they'll have a similar group of public pension funds. We're an endowment, but they'll have a similar group that's size adjusted.
There is a peer group, though, for
Yes, sir.
public pension groups.
Yes, sir.
That are very large.
Yes.
It's interesting we don't get that information relative of the performance of the ERS and TRS relative to their peer group, which is disheartening because it's on graphic form that looks really nice. So y'all are above the 75th percentile for performance relative to the peer group. Going to your page 15, the same thing. Y'all certainly illustrated the returns relative to your peer group. That benchmark group is that same group of same aggregate group.
Yes, sir.
Yeah, and that. I applaud you for showing all the returns, the 1, 3, 5, 7, and 10. The 3-year return was omitted in the ERS data that was given to us because it was omitted. I guess I don't know why they didn't give it to us, but TRS at least has it, I think, in the presentation upcoming. On the next page there, page 16, you very clearly outline your asset allocation currently, and that's helpful in how you benchmark it. That's also good information that I think members of the committee, or myself at least, like to see how y'all are actually operating and what you're benchmarking each individual kind of sub-portfolio in.
Senator, if I may, I might want to call the committee's attention, back to 15, the 3-year return. It's important to note that this incentive compensation plan that was put together by Mercer is linked specifically to demonstrated excess returns over our market benchmarks and our peers, and it focuses on a 3-year number. So we don't pay anybody any performance incentive comp unless we have delivered excess returns. And the excess returns that we deliver are then the plan is capped at 150 basis points or 1.5% over our benchmark returns. To give you a sense of the scale, for us to be able to be at the higher end of our plan potential, which could be on order of all-in compensation of about $30 million, we have to generate almost $900 million of excess returns. So the payoff is significant. And I just wanted to point that out since we were looking at that 3-year return. If we don't generate excess returns, nobody gets any incentive.
And you do this all with a cost for administration of
Net.
9.7 basis points?
And all the underlying costs of the different funds and everything else. We're netting every single cost out. So, if you think about it in the real estate world, a triple net, I hate to say there's so many layers of costs in the investment world. It's probably 12 layers of net to get, but we base it on the bottom line after any and all costs.
Thank you for your information.
Right. Senator Creighton.
Thank you, Madam Chair. I just wanted to tell you the same. Thank you for the presentation and what you brought to the committee as far as what we have to look at on performance. Great changes that you're making. Appreciate the updates we've been able to share in person. Thank you for what you're doing.
Thank you, sir.
Thank you,
Yes,
Madam
sir.
Chair.
Yes, sir. Thank you. Thank you for being here. That's all the questions we have. I'm sorry, Senator West, you're recognized.
I'm sorry, Madam Chair, I didn't have it on. I'm on page 16. When you asset class private equity, what is that?
So it's pretty simple to just think about it. We have companies in America that are publicly traded. They're listed on the New York Stock Exchange or NASDAQ or something else. And you have companies that are privately held, not listed. So that's what they are. They are companies that have not yet gone to be a listed, publicly traded company, but otherwise, have all the features of every other company.
Can you give me an example of one?
Well, I mean, look, we look no farther than Dell. Dell was a private company that became a public company, went to become a private company again. So, most all publicly traded companies started as private.
I understand it. What I'm asking is that you have a private company that's not publicly traded that the PSF invest in?
Yes, sir.
This is?
Yes, sir. We have hundreds and hundreds of them.
Okay.
And in fact have I don't think I had maybe the data's on this Texas First slide. We've got about $3 billion worth of them in Texas, too.
And all of them are pretty solid investments, getting your rate of return?
That's certainly what we hope. In the world of private equity, you try to invest in several companies and grow them into a mature company that ultimately will have an exit where you monetize this. Typically, that's going public, but it can be sale to a strategic or what have you.
I understand all that. That
Right.
was not my question.
Okay.
Have we had any failures with the private equity companies that we've invested in?
Certainly. Okay, because there's literally
Had
been
any-
thousands of
Hold it,
underlying
hold it,
companies.
Hold it. Have we had any recent failures with private equity companies? Recent being defined as
Yeah.
in the last 3 years.
Yeah. I'm happy to get you the exact answer on that, so I don't want to speculate. They're in proportion to the total private companies, it's a minuscule percentage.
Minuscule being defined.
I mean, less than 1%. It's a fraction of a percent of that pool.
How much do we lose?
Well, in some cases in private equity, you lose all your money.
I'm not asking in some cases, I'm asking in the PSF case.
Well, I'll put it this way. We bake all those into the returns, right? So if you had this portfolio of, say, 10 companies, typically, when you think about venture capital particularly, you might have out of 10 companies, 2 or 3 that are total losers. They just didn't work. The idea was good. You write it
All
off.
due respect, because I know the Madam Chair wants to move on.
Okay.
I asked a specific question.
I would.
Again, if you didn't understand it, it's probably.
No, I understand it, sir.
Communicated right.
I would like to give you the accurate answer. So if you would allow me, if I would follow up with you with exact statistics on that question.
Okay, that'd be within the last 3 years. That's
Yes,
what
sir.
I'm asking. Okay.
Will do.
DEI. Talk to me. Have you had to stop doing business with companies that quote unquote have DEI programs?
No, our only policy that we've implemented was focused on companies that were overtly anti-oil and gas.
Okay, thank you very much.
All right. That's all the questions we have. Thank you very much for being here.